Yes, everyone. Can you let me know is the audio video is everything fine or not? So that we can start our today's class. Now, is everything fine? Very good morning, everyone. How are you all? Everyone fine, super, very good. I am also doing great. So last class we started India's 37 provision, contingent liability and contingent asset. I hope you have completed all the questions of all the concept whatever we have done. And if you have not done, once again, it is my humble request that once the concept is completed, you need to do all the questions whatever has been given as a reference for that particular concept. That is our only objective. What is the objective of this class? By the end of the entire syllabus, you should complete all the questions either with my help or by your own. Got this point? Yes, sir. Now let us have a quick revision of whatever we have done in the last class. We started with the definition of provision. What is the meaning of provision? Provisions are liability of uncertain amount or timing, which require substantial degree of estimation. What is the meaning of liability? Liabilities are present obligation arising from past event, the settlement of which is expected through outflow resource from the entity. Got this point? This is the meaning of liability. Means if there is a present obligation from past event, that will only give rise to liability. And if that amount or timing require amount of payment or timing of settlement require estimation, that liability become provision. Means can I say in this way all provisions are liability but all liabilities are not provision? Yes, sir. Then what is the meaning of present obligation? Present obligation means any obligation which is probable on reporting date. Then that obligation is said to be present obligation. What are the three conditions to be satisfied for recognition of provision? There are three conditions. Point number one, there must be present obligation arising from past event. Outflow of resource required to settle the obligation must be probable, and reliable estimation can be made for the amount or timing of the obligation. Now we have understood that obligation here are of two types: legal obligation and constructive obligation. Legal obligation arises due to contract or due to any other legislation of law, means due to any act. However, constructive obligation arises by entity's own action. It may be due to past practice or published policies or any specific statement. Okay, it means whenever you are just identifying obligation, you need to identify whether there is any legal obligation or constructive obligation arising due to past event. If yes, first condition is satisfied. Then we have done one special point कि only those obligations which exist independently from entity's future conduct of business should be recognized. Means any obligation which is dependent on future conduct of business should not be recognized as provision. Okay. Then we discuss about that obligation involve other party, but the identification of that other party is not essential to recognize provision. Then one special point we have done about legal obligation. Legal obligation which arises due to act. So legal obligation arises only when legislation are enacted on or before reporting date, or there is a virtual certainty that it will be enacted soon. Understood? It will be enacted soon. Means the virtual certainty must exist at the end of the means on reporting date. Then coming to contingent liability, what is the meaning of contingent liability? Contingent liabilities is a present obligation arising from past event, which cannot be recognized as provision because either outflow of resource which is required to settle the obligation is not probable, or reliable estimation cannot be made, or it is a possible obligation arising from past event, the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event which is not wholly within the control of entity. However, I have already said this is the key word. If you just write down possible obligation arising from past event, more than enough in exam. So what is possible obligation? If the obligation on reporting date is not probable, then it becomes possible obligation, means chances are less than 50%. For recognition of contingent liability, we don't recognize it, we only disclose it in our financial statement unless the outflow is removed. Then we have done one special point about when the entity is jointly or severally liable for an obligation, the part of obligation that is expected to be made by other party will be recognized as a contingent, will be considered as a contingent liability. So will be treated as a contingent liability. Then we have also done the meaning of contingent asset. Contingent asset, very simple. These are possible assets arising from past event. Any possible asset arising from past event are contingent asset. the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future events which are not within the control of the entity. Now, for recognition and disclosure, what India says that if the inflows are virtually certain, so actually it need to be recognized as an asset. Then we recognize an asset and corresponding income. Means it will not be treated as contingent asset. But if inflows are probable, virtually certain means when the chances are more than 95%. But when the inflows are only probable, then it will be considered as contingent asset, and contingent asset require disclosure in the financial statement. Okay, but if it is not probable, then no treatment. Not probable, or we can say remote, then no treatment. Understood? Yes, sir. Then we have done about measurement of provision. So we have understood that the amount recognized of provision should be the best estimate of future expenditure which is required to settle at the end of reporting period. When I say best estimate of expenditure required to settle the obligation at the end of reporting period, it means the amount of provision shall be present value of future expenditure. If the effect of time value of money is material, means from examination point of view, if the rate of discount is given, recognize provision at a discounted amount. If the rate of discount is not given, recognize provision at an undiscounted amount. Only this much. Are you able to understand? Yes, sir. Then discount rate should be pre-tax and provision should be always measured before tax. This is very simple. Then we have understood that whatever estimation determined, that is determined by management judgment. However, it should be supported by experience of past transaction or report of an expert or any additional evidence provided by the event occurring after balance sheet date. That will be discussed in our next chapter, that is Ind AS 10. How to measure? Very, very important. There are two methods, expected value method and most likely outcome method. Whenever obligation involve large population, then we determine expected value of obligation, that is weighted average of all possible outcome. All possible outcome will be given in the question. However, when there is a single obligation with two possible outcomes, then we actually recognize provision based on the most likely outcome. So whatever most likely outcome is there, that will be the amount of provision. Okay, of course, if discounting is required, then we'll discount it. Then one point we have discussed about gain from expected sale of asset. Any gain from expected sale of assets should not be taken into account for recognition of provision. That will not be taken into account. Risk and uncertainties, we have understood that whenever there is a risk that amount to be paid may be in excess of the amount estimated, then we apply some risk adjustment. The risk adjustment can be done in three ways. Either by adding to the expected present value of future outflow, correct, or by adjusting the estimate of future outflow, or by adjusting the rate of discount as per the information given the question. Means you can apply either of these three, but as per the information means as per question. Understood? Yes, sir. Up to this, any doubt? Up to this, if you have any doubt, you can ask me, otherwise we will proceed. Now, let us start the special point of this chapter. The first point is reimbursement. Means there are four special points. Write down. Four special points from which question may come in exam. First is known as reimbursement. Second is onerous contract. Third is future operating loss. And fourth is restructuring. Normally we expect at CA final level question from this topic. Correct. But try to understand whatever concept was required that already we have done. Means once you know the concept, you can apply your own common sense and just identify what can be the answer of this particular point. Okay, means you can give your own judgment if you know the concept. So I will just inform you what is the case of this particular concept, and you need to apply your common sense whether provision will be required or not required. Okay, sir. Let us come to reimbursement. Reimbursement means, try to understand reimbursement. The topic from topic you can understand what actually I just want to discuss. Means whenever expenditure which is required to be settled, so any expenditure which is required to be settled is expected to be reimbursed by third party. Means whenever there is an expenditure which is required to be set up, for that a provision is required. For that a provision is required if three conditions are satisfied. So whenever expenditure required to be settled, for that provision is required if three conditions is satisfied, or it may be disclosed as a contingent liability, or it can be disclosed as a contingent liability, or it can be disclosed as a contingent liability. Correct. Now the question is that if that expenditure for which provision is required or disclosure of contingent liability is required, if that is expected to be reimbursed by third party, what accounting treatment will do for the reimbursement? So one doubt will come. If suppose that expenditure is required to be reimbursed, if that expenditure which is required to be settled is expected to reimburse, so whether recognition of provision is required or not required. Are you getting? Means in simple word, when I am saying, suppose this is 31st March and there is a legal case pending, and there is a present obligation and all other conditions satisfied, and the estimated outflow is equal to 10 lakh. Estimated outflow is 10 lakh. Understood? Correct. And one of the director of the company has given a commitment that they will reimburse this amount at the time of settlement. At the time of settlement. Means reimbursement can be from any third party. It can be insurance company also. Quite possible. Now the question is that if that amount is going to be reimbursed, whether we require any provision. So just try to understand expenditure means outflow and inflow are two different points. So of course for these we need to apply Ind AS 37, and it will be either recognized as provision or disclosed as contingent liability. There is no doubt about that. Means we are not discussing about this. This will be recognized as provision or disclosed as contingent liability as per the requirement of Ind AS 37. Now we are discussing about what about this reimbursement. Okay, this reimbursement is nothing but one expected inflow. Expected inflow means, can I say, it is as simple as possible asset. So this becomes possible asset arising from past event. So can I say we need to apply the concept of contingent asset? We need to apply the concept of contingent asset. Got this point? Now if you have understood this much, now answer is with you only. So what our Ind AS 37 says that if the reimbursement is virtually certain, means chances are more than 95%. Correct? Then we need to recognize reimbursement as a separate asset. Means you cannot set up the amount of reimbursement with the amount of provision. Provision will be a separate liability. Reimbursement will be a separate asset in our balance sheet. Then recognize reimbursement as a separate asset. However, in statement of profit and loss, net amount will be recognized as an expense. Means the amount of reimbursement will be deducted from the amount of provision, and the net amount will be recognized as an expense. Means in balance sheet we cannot offset, but in SOPL we can offset. Understood? To recognize reimbursement as a separate asset. However, such amount is set off against provision and net amount is shown in PL. And net amount is shown in PL. Understood? Yes, sir. Means what I just want to say. If we in balance sheet, can you see we will disclose provision as a separate item and reimbursement asset as a separate asset. For example, suppose this is 10 lakh and this is 9 lakh, so this will be separate. But in SOPL, in expense side, we write down provision net of reimbursement asset. Means it will be 10 lakh minus 9 lakh, that is equal to 1 lakh. Understood? One point is clear, that the amount of reimbursement asset should not exceed the amount of provision. Means how much amount of reimbursement asset can be recognized? It can be either equal to the amount of provision or it can be less than the amount of provision, but it cannot exceed the amount of provision. Understood? It is clear only. That is only given. The amount recognized as a reimbursement asset should not exceed the amount of provision. Should not exceed the amount of provision. Simple. Yes, sir. If it is not virtually certain, then there can be two cases. Either it is probable or not probable. Can you see, if it is probable, then it should be disclosed as a contingent asset. If it is not probable, then no treatment. So not recognized as an asset. However, if the inflow is probable, expected reimbursement should be disclosed in our notes to account. Very simple. Correct? Got this point? There are some questions given. We can do one of the questions. Come to question number this. I like this question. Come to question number 9. First, let us take one simple question. X Beauty Solution Limited is selling cosmetic product under a brand name B, but it is getting its product manufactured from Y Limited. Okay. It has an understanding with Y Limited that if the company become liable for any damage claim due to any injury or harm to the customer of cosmetic product, 30% will be reimbursed to it by Y Limited. So if suppose some damage caused to the customer of X Limited, how much will be reimbursed by Y Limited? 30%. During the financial year 2001-2002, a claim of rupees 30 lakh demanded by the customer from X Beauty Solution Limited. So how much claim demanded? 30 lakh. So can I say we need to assume that all the three conditions satisfied and we need to recognize the provision of 30 lakh. Okay, sir? Because no information has been given, but it is understood from the emotions of question. Can I say we need to recognize the provision of 30 lakh? How should X Beauty Solution Limited account for the claim that become payable? So of course, they have asked for the amount of the claim become payable, but can 30% of the amount of the claim is reimbursed? 30% become how much? That is equal to 9 lakh. Therefore, we should recognize a separate reimbursement asset of 9 lakh, and in SOPL, we should recognize a net expense of 21 lakh that will be charged to profit and loss account as an expense. Got this point? So since the understanding result in an enforceable agreement, that is understood because there is a contract, the reimbursement of 9 lakh shall be recognized as a reimbursement right, is reimbursement asset, and provision will be recognized for rupees 30 lakh. The reimbursement right shall be treated as separate asset and shall not be offset with the amount of provision in balance sheet. However, in SOPL, the expense may be presented as a 21 lakh after offsetting the reimbursement right. Only this much is the solution. Let me take one more question. First, a more interesting. Come to question number, I think, this. I like this question personally. During the year, QA Limited delivered manufactured product to customer K. So QA Limited delivered manufactured product to customer K. K is the customer of QA. The product were faulty, and on 1st October 2016, customer K commence legal action against the company claiming damages in respect of losses due to supply of faulty product. So customer K has filed a case against company. Okay. Upon investigating the matter, QA Limited discovered the product were faulty due to defective raw material purchased from supplier F. So QA Limited found that it is because of the sum of the raw material purchased from the supplier. Now they will file a case against what? Supplier F? Yes, sir. They found 1st December 2016. 1st December 2016. The company commenced the legal action against F claiming damages in respect of the supply of defective raw material. Understood. It means there are two cases. We are doing question number 23. Question number 23. So QA Limited, we are discussing this particular case study from QA Limited point of view. So there is one customer K. Customer K filed a case against QA Limited. And QA Limited filed a case against supplier F. This is the point. The date was what? The date of filing was 1st October 2016. This is 1st October 2016 and this is 1st December 2016. Okay, sir. Now what is given? QA Limited has estimated its probability of success. QA Limited is now estimating the probability of success of both the legal action, the action of K against QA Limited, K against QA Limited, and action of QA against F is very high. Means action of K against QA Limited is very high. Means the chances of winning the case by K is very high. And in the second case, the chance of winning the case by QA Limited is very high. Means can I say, in this case, there is a possible loss. Am I right or not? Means for this particular case, for this particular case, there is a present obligation. There is a present obligation. And for this case, can I say there is a chances of what? Loss, or you can add on, in this case QA Limited is, there is a chances of loss and there is a chances of win. We can add on in this way. Understood? This para is simple. Yes, sir. Correct. Now on 1st October 2016, QA Limited has estimated the damage it would have to pay to K would be 5 crore. So on this date, they are estimating that this amount may be payable. Okay, sir. Then this estimate was revised to 5.2 crore on 31st March 2017. Means on reporting date. So on reporting date, on 31st March 2017, the amount become 5.2 crore. The estimated amount become 5.2 crore. Okay, sir. Then 5.25 crore as on 15 May 2017. So on 15 May 2017, the amount of estimation now become 5.25 crore. Okay, sir. So on 15th May 2017, it become 5.25 crore. Okay, sir. This case was eventually settled on 1st June 2017 when the company paid the damage of 5.3 crore, and actually what was the amount paid? That was 5.3 crore, and the date of settlement was 1st June 2017. So on 1st June 2017, what is the amount actually paid is 5.3 crore. So they have given 4 amount they have given. Okay, sir. Similarly, for the second case, they have given 4 amount. On 1st December 2016, QL Limited has estimated it would receive a damage of 3.5 crore. Okay, sir. So on 1st December 2016, they are estimating that they will receive 3.5 crore. Okay, sir. This estimate was revised to 3.6 crore on 31st March, 3.6. So on 31st March, it become 3.6 crore. Okay, sir. Then 3.7 crore as on 15th May. Okay, sir. On 15th May, it become 3.7 crore. Okay, sir. Then this case was eventually settled on 1st June when F paid 3.75 crore to QL Limited. Actual amount paid by F to QL Limited is 3.75 crore. Okay, sir. So on 1st June 2017, the actual amount paid was 3.75 crore. So they have given 4 amount. Now there is a confusion. what amount of provisions should be recognized and whether we should recognize reimbursement asset or not. This is the point of question. QA Limited had in financial statement for the year ended 31st March 2017 provided 3.6 crore as the financial statement were approved by Board of Directors on 26 April 2017. What they have written? कि QA Limited in his financial statement for the year ended 31st March 2017 provided means they have created a provision of 3.6 crore. Why they have created a provision of 3.6 crore, we don't know. Means we need to give our own conclusion. Whatever they have done, okay, thank you very much. But our conclusions should be based on Ind AS 37. Yes, sir. But one thing is given that the financial statement were approved by Board of Directors on 26 April 2017. I hope you know Tora AS4. However, our next chapter is Ind AS 10, that is event occurring after reporting date. Correct? But can I say you know about AS4 event occurring after balance sheet date? So date of approval was 26 April 2017. So what is the date of approval? So it will come here. This is 26. It is 26 April 2017. Means can I say any information whatever has been given after approval date that is not relevant. So can I say we know this point that this information is not relevant now. This information is not relevant now. Are you able to understand? Means they have given one information that estimated amount after the date of approval may be 5.25 crore and actual settlement amount is 5.23 crore. But this is after the date of approval. This is not at all relevant for the financial year whatever has been given the question, and therefore we are not concerned about these two amount. Chalega. Now just try to understand, whenever we create provision based on what? Reporting date information. Therefore, this information is also not relevant. So we'll take estimation as on reporting date. It means, can I say, of course, one thing is clear that there is a present obligation arising from past event, outflow is probable and reliable estimation can be made, and therefore we should create a provision of 5.2 crore. We should create a separate provision of 5.2 crore. Understood? In this, I hope no doubt. Now the question arises, whether we should recognize a separate reimbursement asset. Now the question arises whether reimbursement is virtually certain. Now in this case, student may have doubt. What is given the question? Action of QA against F is very high. High does not mean virtually certain. I have already informed you that they will either give you some indication about virtually certain or they will mention the term virtually certain in the question. So if nothing is given, you can't assume by your own it is virtually certain. Okay, the action of QA Limited against F is very high. Means the chances of winning is very high. It does not mean it is virtually certain. It can be probable. It can be highly probable, but it does not mean it is more than 95%. And therefore, in this question, there is no evidence given about virtual certainty. Hence, will not recognize reimbursement asset. Will not recognize any separate reimbursement asset. If it from the point it is understood it is probable, and therefore disclosure is required for the reimbursement asset. This is the solution. Chalega. What are the question they have asked? Whether the company is required to make a provision for the claim from the customer K as per applicable India's. Yes, you write on three conditions. If the answer to A above is yes, what entry to be passed in the books of account as on 31st March 2017? So can you say we will pass one journal entry PL account debit to provision? However, they have asked you from the point of current liability or non-current liability. One thing is understood from this question that the expected settlement date is within 12 months and therefore it will be current liability, it will not be non-current liability. Understood? Therefore, your answer is what? Amount is 5.2 crore and PL account debit to current liability. Option number A is correct. Option number A is correct. Now, what will be the accounting treatment of action of QA against supplier as per applicable Ind AS? So, what answer is given? Let's see. As per Ind AS 37, QA Limited shall not recognize a contingent asset. I will say this sentence wording is not correct. Shall not recognize a asset. We cannot recognize contingent asset. We can disclose only contingent asset. So shall not recognize an asset. Shall not recognize a reimbursement asset. Reimbursement asset. Here the probability of success of legal action is very high, but there is no evidence, no concrete evidence which makes an inflow virtually certain. Hence, it will be considered as a contingent asset and only and shall not be recognized. It will require only disclosure. Understood? Super easy. Good question. Yes, sir. So we have done 2 questions. 9 we have done. 23 we have done. 29 you do by row. Chalega. Reimbursement you understood. Any doubt in this? Any doubt in reimbursement? Now, next point is about future operating losses. Future operating losses. This can is a future operating losses due to future business. Now, you only say, can we recognize any provision or can we disclose it as contingent liability, which is because of future business? No, from the, can I say, from the heading only we can understand this is not covered in this chapter. This is outside the scope of this chapter. Correct now. So simply I will say provisions shall not be recognized for future operating losses as it does not meet the definition of a liability, because liability means present obligation arising from past event, and if I am saying future operating losses means due to future business. Can I say it is outside the scope of this particular chapter, because liability means present obligation arising from past event, but this is the case of what? Operating loss arising from future event, hence outside the scope of this chapter. Chalega. There is one very simple question given, you do by your own. I think no explanation required for future operating losses. Chalega. Then coming to one of the point, executory contract. First let me ask you, do you remember, because I hope you have done contract act, do you remember what is the meaning of executory contract? What is the meaning of executory contract? Bolo. So first let me define what is the meaning of executory contract. So any contract which are neither performed by both the party, or I will say which is performed by both the party to an equal extent, that is known as executory contract. Understood? So in a contract there are two parties. If both the party has not performed their part of obligation, or they have performed their part of obligation to an equal extent, that become an executory contract. So as per definition, any contract under which neither party has performed any of its obligation, or both parties have partially performed their obligation to an equal extent, that is known as an executory contract. Let me take one example. We are discussing about executory contract. Correct. Let's say there is one company X Limited, another company Y Limited. X Limited has done one contract with Y Limited to buy a machinery at rupees 10 lakh after 2 years. Understood? Correct. Now what is the obligation of Y Limited? To supply machinery after 2 years. And what is the obligation of X Limited? Obligation of X Limited is to pay rupees 10 lakh after 2 years. Of course, if the machinery is delivered, this is the contract. Contract you understood. But contract is done right now. Means contract has been done. Contract has been entered. Understood. This type of contract is known as executory contract. Why it is an executory contract? Because in this case, both the party has not performed their part of obligation. Both party has not performed their part of obligation, therefore it become an executive contract. Correct. But can you say there is a contract, and as per the contract, X Limited has an obligation to pay rupees 10 lakh. Now the question arises whether X Limited should recognize the liability of 10 lakh. What do you think? They should recognize the liability of 10 lakh or they should not recognize the liability of 10 lakh. Can you say this is also totally based on future event? Because this is actually future event. This is future event. Even though they have entered into contract does not mean we need to recognize it in our books of account, because we always do accounting based on substance of a form. So as per substance of this transaction, no machinery has been received, so there is no obligation to pay. The obligation arises only when the machinery is delivered by Y Limited. Understood? Very simple. So we always apply substance of a form for accounting treatment. So as per substance over form. Substance over form means what? We always give preference to substance over legal document. Even though contract has been entered, but our accounting treatment should be based on actual happening. Actual happening. So what Ind AS 37 says that Ind AS 37 will not be applicable to executive contract and therefore no liability will be recognized. No liability will be recognized even though there is a contract. Even though there is a contract. In simple word, for executive contract, Ind AS 37 is not applicable. For executive contract, Ind AS 37 is not applicable. Understood? Simple. Correct. So what is given? This standard does not apply to executive contract unless they are onerous. Oh, unless they are onerous. So it means now I need to explain you what is actually onerous contract. What is actually onerous contract? So let me explain onerous contract. Now I will explain you onerous contract. Very, very important. Now same example I will continue. Same example. The X Limited, Y Limited enter into contract to buy machinery at rupees 10 lakh after how many year? 2 year. After 2 year. The contract was done on 1/4/2025 and right now we are at 31st March 2026. Means 1 year has been expired. Correct. But what actually happened? After 1 year, X Limited has changed their production method. Quite possible. Understood? So has changed their production method and now this machinery is no more required. Machinery is no more required. No more required. Normally it happens. It happens with me also after COVID-19. Before COVID-19, we have done one contract for what? For supply of what? Benches. Because that time there was face-to-face classes, so I have done one contract of 50 benches with one of the supplier. But suddenly what happened? COVID-19 came. Now we don't require benches. So the contract was done. The same thing happened with me. So we have also changed our production method. Production method means the classes from face to face to recorded mode or live mode. Now we don't require benches now. I hope you're understanding. So it is practically possible. Practically possible. Contract has been done. Now whenever contract is done, that is enforceable in the eyes of law. Means can you say whenever there is a contract are always non-cancelable. Contract are always non-cancelable. Because if it is cancelable, then this is not a contract, because that is not enforceable by both the parties in the eyes of law. I hope you know about this point. So whenever I say contract, contract is non-cancelable. Non-cancelable contract are those contracts which can be cancelled only upon payment of penalty. Means when I am saying non-cancelable contract, it does not mean it cannot be cancelled. It can be cancelled, but only by payment of penalty. Correct? So non-cancelable contract are can be cancelled upon payment of penalty. Understood? Now, this contract may have one penalty clause or may not have penalty clause. I hope you are understanding. May or may not have penalty clause. That will depend upon the information given the question, whether they have given a penalty clause or not. Means let me give a penalty clause. So this contract can be cancelled by payment of penalty of rupees, let's say 2 lakh. Let's say 2 lakh. Let's say 2 lakh. I hope you understand. Now, one thing is clear that X Limited does not require now this machinery, but the contract is enforceable. Means either they need to fulfill the part of their obligation, means they need to purchase the machinery and pay rupees 10 lakh, or they may cancel the contract by payment of 2 lakh or not. Yes. So this contract was a executory contract but now become onerous. Why it become onerous? Because can you say the expected benefit from this contract, means from X Limited point of view, the expected benefit from this contract is actually less than the expected cost of meeting this particular contract. The cost is more than what? Expected benefit. So whenever cost is more than expected benefit, that contract will become a burden. The contract will become onerous. Whenever we do any contract, why do we do any contract? Because the expected benefit from that contract is more than expected cost. Means right now you are learning from me, means you have given some fees to me. Why you have done this contract? Because you know that expected benefit of this batch is more than the cost, and therefore this particular contract is not onerous for you. This particular contract is not onerous for you. Are you able to understand this point? So now can I say, because of this reason, this contract become onerous. The contract become onerous. Now from X Limited point of view, they have two options. Either to fulfill the contract, means they will pay rupees 10 lakh, or they can cancel the contract by payment of penalty of rupees 2 lakh. So in this case, what Ind AS 37 says, because the contract become onerous, now we need to apply Ind AS 37 and we should recognize all the losses, expected losses. So in this case, what is the expected losses from the point of X Limited? Can I say 10 lakh or 2 lakh, whichever is lower? 10 lakh or 2 lakh, whichever is lower. And therefore, this will be the amount of provision. Are you able to follow me? Correct. So can you say what is the expected cost of meeting the obligation? 10 lakh. You may say, sir, we'll purchase the machinery and we can sell in the market. Yes, if suppose the expected scrap value is given. Suppose the expected scrap value of machinery is, suppose, let's say 6 lakh. It is given the question, then this will become 4 lakh. Then also 4 lakh or 2 lakh, whichever is lower. Or if you will say, sir, expected scrap value means we can sell this machinery in the market at rupees 9 lakh. Then this become 1 lakh. So what is the lower? Now lower become 1 lakh. So whatever is lower, that will be the amount of provision. Whatever is the lower, that will be the amount of provision. That will be as per the information given in the question. Got this point? Have you understood? Yes, sir. So what actually is given? An onerous contract is a contract in which unavoidable cost, the cost which cannot be avoided, of meeting the obligation under the contract exceed the economic benefit expected to received under it. Means unavoidable cost is more than the expected benefit from the contract. That contract become onerous. If an entity has a contract that is onerous, if the entity has a contract that become onerous, Ind AS 37 says that present obligation under the contract shall be recognized and measured as a provision. Present obligation under the contract will be recognized as an amount of provision. Correct? What will be that amount? In this case, the amount of provision will be equal to unavoidable cost. Will be equal to unavoidable cost, the cost which cannot be avoided. Which will be lower of? Which will be lower of? Cost of fulfilling the obligation. Cost of fulfilling the obligation, or any compensation or penalty arising from failure to fulfill it, or any compensation or penalty arising from failure to fulfill it, means penalty, the amount of penalty, whatever is given the question. So it will be lower of cost of fulfilling the contract, whatever cost which will be incurred to fulfill the contract. In our case, it was 10 lakh, or any compensation or penalty arising from failure to fulfill it. So what will be included in this cost of fulfilling the obligation? For that, one clarification has been given. What is the cost of fulfilling the obligation? What is the cost of fulfilling the obligation? So our Ind AS 37 says that cost of fulfilling the contract, means this part I am discussing now. Are you able to understand? Cost of fulfilling the contract comprise of costs that are directly related to the contract. So any costs which are directly related to the contract will be the cost of fulfilling the contract. So what are the costs which are directly related? So simple word, any costs that relate directly to the contract consist of any incremental cost of fulfilling the contract. So what do you mean by incremental cost? In simple word, I will say any cost which will be incurred only when that contract will be fulfilled, that become incremental cost. Means any cost which will be incurred even though the contract is not fulfilled, that is not incremental cost. Just try to understand. Right now I am taking my batch. So if I will conduct this batch, so I need to incur electricity expenses. So it means electricity expenses are incremental cost. If I will not conduct this batch, so can I say I will not come in this studio, so I will not incur any electricity cost. In that case, this electricity cost become what? Incremental cost. I hope you are understanding. Can I say the cost of providing the classes? The means whenever I am providing my classes in the app, so I need to incur some encryption cost. What is encryption cost? That I will not explain, but I need to incur some encryption cost. Can I say that will be incurred only because of this contract only? If there is no such contract, I will not incur encryption cost. So therefore, encryption cost become what? Bolo, incremental cost. But just try to understand. Suppose this studio is in a rented premises. But just try to understand. Suppose this studio is in rented premises. So even though I do not fulfill the contract, I need to pay the rent. So rent is not an incremental cost. Because contract is not fulfilled. Then also I need to pay the rent. I need to incur the rent expenses. Got this point? Yes, sir. So the incremental cost of fulfilling the contract, for example, direct labor and material cost, any material or direct labor cost, got this point? Or any allocation of directly attributable cost, or any allocation of the cost which are directly attributable. For example, the depreciation for an item, a PP, used in fulfilling the contract. Right now, I'm using camera. Camera is my property, plant, equipment. Can I say I'm using the camera only to provide the classes? So the depreciation of camera will be one type of incremental cost. Correct. But can I say this camera will be used in number of batches? Not only in these matches. Right now I'm also conducting one Hindi batches. So this camera will be used in that Hindi batch also. So it means the depreciation will be allocated in my English batch and for Hindi batch. Are you able to follow? Yes, sir. So can you repeat with me? Costs that relate directly to contract comprise of what? The incremental cost of fulfilling the contract, as well as an allocation of directly attributable cost. However, means one clarification has been given: the unavoidable cost of meeting the obligation under the contract are only costs that are incremental. One second, one more clarification has been given when I am saying unavoidable cost. This word has been given, unavoidable cost. The unavoidable costs of meeting the obligation under the contract are only costs that are incremental to the performance of the contract, which are only incremental to the performance of the contract. Now you have understood what is incremental, correct? Do not include, but it will not include. It will not include allocated costs that will be incurred. Allocated costs that will be incurred whether the entity fulfill the contract or not. Means any cost which will be incurred whether the contract is fulfilled or will not be fulfilled, that costs are not incremental costs. Means simple what I can say, any costs which are not incremental will not be unavoidable costs. Correct? Yes, sir. Do not include any allocated costs which will be incurred whether the contract has been fulfilled or not fulfilled. Yes, sir. And cannot be avoided by entities future actions. Means unavoidable costs are those costs which cannot be avoided by entities future actions. Unavoidable cost. I hope this is giving more clarification. Chalega. In simple word, from examination point of view, unavoidable cost will be lower of cost of fulfilling the contract and any penalty arising from failure to fulfill the contract. Yes, sir. Correct. Understood. This much you understood. You can see there are so many reference questions. It is very important from examination point of view. Very means this is super important. Super very important from examination point of view. Now one clarification has been given by Ind AS 37 because whenever you fulfill any contract, there may be some dedicated asset. Dedicated asset means they can be camera, means property, plant and equipment or intangible asset. Now for property, plant and equipment and intangible asset, there is one Ind AS 36 coming soon about impairment. Just try to understand whenever a contract become onerous. Suppose right now I am taking a batch and this batch become onerous for me. Onerous means what? Just try to understand. I am just taking one example. Okay, suppose I have done one contract to teach you. We have not started. Means till now we have not started our batch. But let's say this contract become onerous. So in this contract I will use this PP. It means, can you say now I will not be able to recover the carrying amount of PP. So Ind AS 36 will be applicable for impairment loss. Impairment loss is coming soon in your life. Right now I am not going to discuss anything about impairment loss. I have just given one point so that you can understand whatever I am saying. So can you say whenever an asset is involved in a contract, an asset is in the nature of property, plant and equipment or intangible asset, it is quite possible there may be some impairment loss on that asset because we are not able to recover the carrying amount of that particular asset because we are not able to use it. So one clarification has been given in this particular Ind AS 37 before a separate provision for an onerous contract. Means before recognizing any provision for onerous contract, correct, entity recognize any impairment loss. Entities should recognize any impairment loss that has occurred on asset dedicated to that contract. Means first recognize impairment loss on that particular asset which are dedicated to this contract as per the requirement of Ind AS 36 or as per the respective Ind AS. Then for the balance amount create provision for onerous contract. Understood? Means first we need to apply impairment loss Ind AS and then apply Ind AS 37. Correct? So first recognize impairment loss. I'm just writing Ind AS 36 because it will be covered under Ind AS 36 coming soon. Then second, for balance, recognize provision for onerous contract. Provision for onerous contract. Understood? Yes, sir. Yes, sir. Now there are many questions. I will do some questions only. Come to one of the question which will give you this is the question which is already asked in exam and I have taken as a example also. I'll just read the question. Sun Limited has entered into a binding agreement with Moon Limited to buy a custom made machine for rupees 4 lakh at the end of 1718. Before delivery of the machine, Sun Limited had to change the method of production. The new method will require the machine order which is to be scrapped after delivery. Which is to be scrapped means scrap value is nil. They have not given any scrap value of machinery. The expected scrap value is nil given also. Given that asset is yet to be delivered, should any liability be recognized for the potential loss? Yes, because now the onerous now the contract become onerous. If so, give reason for the same and amount of liability as well as the accounting entry. So, of course, we need to create a provision for onerous contract with an amount equal to unavoidable cost, which will be lower of cost of fulfilling the contract. Cost of fulfilling the contract is 4 lakh and there is no penalty clause. So, point number B, they have not given. Therefore, we should create a provision of 4 lakh for this particular case. What will be journal entry? Journal entry is what? Profit and loss account debit to provision for onerous contract. What is journal entry? Profit and loss account. However, they have given 2 journal entry. You can pass 1 journal entry in exam. PL account debit to provision for onerous contract. But they have given 2 journal entry. First expense account debit to provision. Then PL account debit to expense. Correct? Means expense. Onerous contract provision expense. Means what is this name of account? You can simple write down onerous contract expense account, means onerous contract provision expense. Are baba. Onerous contract expense account to provision for onerous contract. Then PL account debit to onerous contract expense account. This is the answer. Chalega. Okay. Already asked in exam for 4 marks. Already asked in exam for 4 marks. Okay. Then there is one more question for understanding this particular onerous contract. Can you read this question by your own? Read it. This will give you better understanding. However, from my point of view, you will be able to understand this is for better understanding the onerous contract. Just do it by your own. Read it. Not now. Whenever you are free. I will like to take one more question. Come to question number 35. Okay. What is given? This is very important. Expected. Write on MRQ. Must revise question. Entity has a contract to purchase 1 million unit. 1 million means 10 lakh. Unit of gas at 23 paise. So 10 lakh into 23 paise. How much amount? This 10 lakh into 0.23. It is 2 lakh 30,000. Sometime now we are confused. 2 lakh 20,000. Giving a contract price, or it is given only 2 lakh 30,000. Why I have calculated? The current market price for similar contract is 16 paise per unit. Giving a price of 1 lakh 60,000 means already they have entered into contract to buy 1 million unit of gas at 23 paise, but currently it is available in the market at 16 paise. Oh ho ho ho. The gas will be used to generate electricity, which will be sold at a profit. If it is sold at a profit, it is not an onerous contract now. It is not an onerous contract. State whether contract is onerous. No, because can I say expected benefit from this contract is more than the unavoidable cost of meeting the contract, and therefore it is not an onerous contract. Even though right now such unit of gas is available at 16 paise per unit. Understood? So it is not an onerous contract. The contract is not an onerous contract. Understood? Good question. Sometimes we are confused. Now it is available at 16 paise. Okay. Second, entity has a contract to purchase 1 million unit of gas at 23 paise, giving a contract price of 2 lakh 30,000. Similar point. The current market price of similar contract is 16 paise per unit, giving a price of 1 lakh 60. Similar point. The gas will be used to generate electricity. Okay. However, the electricity is sold at a loss. An entity makes an overall operating loss. All of the gas purchased by the entity is used to generate electricity using a dedicated asset. The electricity is sold to a wide range of customers. State the contract is onerous or not. Just try to understand. Right now they have not purchased the unit. They enter into contract. If they have already done one contract and they have purchased it, then it is not an executive contract. This onerous contract wala point will be applicable only for executory contract. Suppose I purchase it and now I started generating electricity, then this contract means this onerous contract wala point will not be applicable. So we enter into contract. Right now we have not purchased it. Means we have, the unit of gas is not received by us. and now it is available in the market at a discount at a lesser price. And when we'll use this gas to generate electricity that can be sold only at a loss, means the contract become onerous. Now the contract become onerous, and if the contract become onerous, we should make a provision for onerous contract with an amount equal to unavoidable cost. That will be lower of cost of fulfilling the contract and any penalty to exit a contract, whichever is lower. However, if there is some dedicated asset and there may be some impairment loss on dedicated asset, so first we should recognize the impairment loss on dedicated asset, and for the balance amount we should recognize provision for onerous contract. This is the answer. So entity first consider whether the asset used to generate electricity are impaired. To the extent that there is still a loss, after the asset has been written down, a provision for onerous contract should be recorded. Okay, yes sir, yes sir. You can't find out because the entire information has not been given. Because for this we require also what is the amount of loss, that is not given in the question. Point number 3. Entity has a contract to purchase 1 million unit of gas at 23 paise per unit, giving a contract price of 2,30,000. The current market price, same thing, is given 1,60,000. The gas will be used to generate electricity. However, the entity sell the gas under contract which it no longer need. However, the entity sell the gas under a contract which it no longer need. Means now they don't require this gas to a third party for 80 paise, means now they don't require this gas but they can sell this gas at 18 paise per unit, 5 paise below cost. The entity determined that it would have to pay 55,000 to exit the purchase contract, means there is a penalty clause. State whether the contract is onerous. Yes, the contract is onerous, it is understood point. If the contract is onerous, then also state the amount of provision to made on account of onerous contract. Means we need to first find out what is the unavoidable cost, means cost of fulfilling the contract. So they will purchase at 23 and they can sold at 18, means it become 5 into what, 10 lakh, so it becomes 50,000. So A is 50,000 and the penalty clause is what, 55,000, whichever is lower, and therefore we should create a provision of 50,000. We should create a provision for onerous contract for 50,000. Understood? The same I think given. The only economic benefit from purchase contract cost 2,30,000 are the proceeds from the sale contract, which is 1,80,000. Therefore, provisions should be made for the onerous element of 50,000 being the lower of cost of fulfilling the contract and the penalty cost of cancellation. Chalega? Good question. Point number 4. In the year ended 31st March 2001, the entity has a contract with the third party supplier. The entity wishes to terminate the contract in 2001-2002, even though it will still have 2 years to run, because it can enter into a cheaper contract with a new supplier. It will incur a charge for terminating the contract. Thus, the entity have to provide in 2001 for the contract that it will be Thus, the entity has to provide in 2001 for the contract that it will be existing in 2001-2002. Yes, exiting. Exiting means they will exit the contract. They will cancel the contract in the next year. Yes, because here also it is an onerous contract. A provision should be recognized only if the contract is onerous. If the good received under the supply contract are sold at a profit. Acha, it is not given whether it will be sold at a profit or not. The contract is not onerous and provisions should not be made in the year. Okay, the termination contract should be recognized. The termination cost should be recognized as incurred. Acha, this is not. Acha, 1 minute. Acha, they have not given whether it will be sold at a profit or sold at a loss. Means we cannot assume by our own whether it will be sold at a profit or sold at a loss. So I will say in this there is a doubt whether it is an onerous contract or not. So you can give 2 suggestions. If the contract is onerous, then we should create a provision. Otherwise, we should not create a provision. If you are not creating a provision, then termination cost will be recognized as an expense in the next year. In the next year when it is actually incurred. Chalega. Good question. That on MRQ. Good question or not? Yes, sir. So we have done which question? 35 we have done. Then I think 24 I have done. One question I have asked you to read. Balance all question you can do by your own. My help is not required. Correct. Understood. Now come to some small point. Changes in the amount of provision. Of course, can I say provision amount should be reassessed at the end of each reporting date, because can I say the condition might change, the circumstances might change. So what India 37 says, that amount of provision should be reassessed at the end of each reporting period, and any changes in the amount of provision should be transferred to profit and loss account. If increase in provision or decrease in provision, that should be transferred to profit and loss account. It is quite possible that in the next accounting year, next reporting date, provision is no longer required. If the provision is no longer required, the amount of provision should be reversed. Amount of provision should be reversed. Simple. The provision must be reviewed at each reporting date and adjusted to reflect the best current estimate. If provision is no longer required, as it is not probable, amount of provision must be reversed. Simple. Yes, sir. Then point number X, unwinding of provisional amount. Unwinding of provisional amount, a new term in your life, unwinding. Unwinding, what I said initially, try to understand. Try to understand. One minute. Suppose provision is required here, an amount is payable after 2 years, and future expenditure is equal to 1,21,000, and rate of discount is equal to 10%. This is Y0. It means what is the amount of provision? You will say 1,21,000 into discounting factor, and discounting factor will be 826. So 0.826, it will be equal to approximately equal to 1 lakh. Approximately equal to 1 lakh. Means what journal entry will do? At Y0 we'll say profit and loss account debit to provision 1 lakh. Correct? Let us assume that future expenditure remains same. Means there is no change in the future expenditure. This remains same. Let us assume that. Means whatever we estimated, the actual remains same. Means there is no changes in the amount of provision at each year end. Okay, sir. But try to understand, we have recognized an amount of 1 lakh, but the amount payable is 1,21,000. So the difference between 1 lakh and 1,21,000 is interest cost. So what India 37 says, that you need to unwind the amount of provision so that at the end of 2 years it is equal to 1,21,000. 1,21,000 means what we have done, this is discounting, and when we move from 1 lakh to 1,21,000, this is known as unwinding of discounted amount. Unwinding. So first we have done discounting, now we are doing unwinding of discounted amount. Means, can I say, at the end of each year we need to add interest element. So first year we'll say interest account debit to provision. First year it is 10,000, and at year end 2, once again interest to provision, it is 11,000, and once you have added 10,000, 11,000, the amount payable now become 1,21,000, which is nothing but the amount of future expenditure. This is known as unwinding. This is known as unwinding. Unwinding. Correct. And interest, we call it as borrowing cost. The borrowing cost. So this will be recognized as a borrowing cost. Borrowing cost. Understood. And charged to profit and loss account as an expense. It will be charged to PL account as an expense. Simple, super easy. Yes, sir. What is given? When discounting is used, of course, discounting will be used only when the effect of time value of money is material. The carrying amount of provision increases every year. Of course, the carrying amount will increase with the amount of interest. That increase amount is treated as borrowing cost. The increased amount is treated as borrowing cost. The increased amount is treated as borrowing cost. Understood? Correct. There are two questions given, 7 and 10. I think you can do it by your own. If you want me to read, I will read on your behalf. But super easy. You can do it. But one doubt coming, question number 7. Let me explain the doubt also. Come to question number 10. What is given? X Telecom Limited has an income tax litigation pending before appellate authority. Legal advisor opinion is that X Telecom Limited will lose the case and estimated that liability is 1 crore. May arise in 2 years. May arise in how many years? 2 years. The liability is recognized on a discounted basis. The liability will be recognized on a discounted basis. The discount rate at which the liability has been discounted is 10%. And it is assumed that discount rate does not change over the period 2 years. Means it is assumed that discount rate has not been changed, it remains same. It may also change. How should X Telecom Limited calculate the amount of borrowing cost? We need to calculate the amount of borrowing cost. So we are doing question number 10. So right now our reporting date, let's say this is Y0, this is Y1 and this is Y2. Means I am saying suppose this is, the date is not given. This is suppose 31st March 2025. This is 31st March 2026. This is 31st March 2027. So on 31st March 2025, we'll pass one journal entry, profit and loss account debit, to provision for, you can add on provision for income tax litigation, correct? Provision for, you can add on legal damages, better. Or you can add on income tax litigation also. What will be the amount? 1 crore. Can I say multiply by 826 because 2 years? It become 82 lakh 60,000. 82 lakh 60,000. But if you see the answer, they have done by 8 to 7. So of course our 8 to 7 but multiply by 8 to 6. Wow. So our answer is matching. But can you say we can also take 0.8264? 0.8264, then our answer will not match with ICS solution. In that case also your answer is correct, nothing to worry. You can take 826, you can take 8264, you can take 5 decimal also. Whatever you are taking, just write down here. Write down, mention here. So we have mentioned now, just mention and just write down the answer. Then 31st March 2026. Can I say, we'll say borrowing cost. That will be transferred to PL account. Debit. To provision, so 82 lakh 60,000 into 10%, that is 8 lakh 26,000. 8 lakh 26,000. Then again on 31st March 2027, borrowing cost, PL account debit to respective provision. So can I say at the end of second year we should calculate as a balancing figure because the amount should be equal to 1 crore. So our amount is coming 90 lakh 86,000 minus 1 crore. That will be equal to 9 lakh 14,000 due to approximation difference. This you all know because you know about FM. Last year always we take as a balancing figure. 9 lakh 14,000. This is the answer. This is the answer. Correct? Okay, sir. But their answer will thoda sa differentiate because they have done in some other way. What they have done, our answer is 100% correct. What they have done, try to understand. Their answer is also correct. Means this was 1 crore and this they have done 8,26,000. What they have done? They are saying at the end of first year, we can do in this way 1 crore multiply by discounting factor for 1 year. So if you apply discounting factor 1 year, it will be what? 0.909. Means this will be 90 lakh 90,000. Now what answer is coming? Check karo. Now the difference will be interest. So 90 lakh 90,000 minus 82 lakh 60,000. It is coming 8 lakh 30,000. Our answer was 8 lakh 26,000. Our answer is also correct. I will say our answer is more perfect. But they have done in this way. But this is also correct. So you can do as per your choice. Answer should be what? Conceptually correct. So I answer is conceptually correct. Their answer is also conceptually correct. So both are correct, I will say. I can't say one is correct, one is wrong. But normally student will have doubt. Therefore, I have explained here. This become 9,10,000. 9,10,000. Understood. Okay, sir. Done. Okay. Then next point is about use of provision. So one clarification has been given by India 37 that provision should be, the amount of provision should be used for only for the expenditure for which it was originally created, originally recognized. Means the amount of provision should not be used for any other purpose. If it is no longer required, reverse it. But you can't use the amount of provision for any other purpose. Understood the point? Correct. A provision should be used only for the expenditure for which it was originally recognized. In other words, it cannot be used for any other purpose. If no longer required, reverse it. Correct. Now, what will be the accounting treatment? If the provision amount means if the provision is related to any expense, the provision can be related to any expense. In that case, for recognition of provision, journal entries were related expense, account debit to provision, or you can say PL account debit to provision. Better journal entry is expense account debit to provision and expense will be transferred to profit and loss account. For recognition of interest expense, right now I have said to interest expense account debit to provision for unwinding of provisional amount. For reversal of provision, if provision is no longer required, then provision account debit to PL means you reverse it through PL. So provision to related expense and that related expense in SOPL will reduce that particular expense. So provision account debit to expense. Understood. This is the journal entry. But sometimes what happens? Provision amount may be related to acquisition or construction of asset. Means whatever provision you are recognizing that may be related to the construction or acquisition of asset. In that case, the amount of provision will be capitalized to the cost price of asset. Then in that case, our journal entry will be property, plant and equipment or any asset account debit to provision. Then interest expense account debit to provision. For reversal also, provision account debit to PP. Because you created through PP, the reversal will be also through PP. Understood? Have you understood this point? Means, have you understood this point? I think this point you have understood. My question to you all, have you understood the second part that provision is related to what acquisition and construction of asset? If you have understood, very good. But I hope you don't know about any of the example for this because I have not taken any example. So I will explain this point once again, but not now. Just write down refer Ind AS 16. When I will do Ind AS 16 property, plant, equipment, then I will take one example for this and there is only one example for this. And that is the best example and very, very important from examination point of view. Just write down refer Ind AS 16. Chalega? Yes, sir. Now coming to restructuring. Restructuring. I think all points are clear, whatever we have discussed. Now restructuring is the last special point. Restructuring. Do you know about the word restructuring? Restructuring. Achha, when we do restructuring, when something something bad has happened, then we go for restructuring. For example, right now I am doing my business from one location, but to increase the productivity, to increase the profitability of a better opportunity, I may shift my this location to another location. Quite possible. This is one example of restructuring. This is one example of restructuring. It is quite possible I want to change my business model from one business model to another business model. For example, from face to face to online recorded classes. This is also restructuring. This is also restructuring. Or I need to terminate my one of the business. I want to terminate, means I have multiple business. I want to terminate one of my business. This is also one type of restructuring. Or I have decided to sell one of my division. Sell one of my division because it might be a loss making. So that is also what? One type of restructuring. Means can I say it is one of the program? It is any program which changes the scope of business, but it changes the scope of business materially, then it is known as what? Restructuring. Means any program which changes materially the scope of business is restructuring. But why we are discussing this point in this chapter? Yes, we will discuss. Let me take one example. When I am saying restructuring, so what India 37 says, suppose you are doing one of the business here, and this is reporting date. This is reporting date. Now you have decided to sell one of your business. I am saying sell one of the business, not entity. If there is sale of entity, then it will affect going concern. I am saying we are going concern only. One business has been, we have decided to sell one business, not entity. Means going concern assumption is valid. GC means what? Going concern is valid. Understood? Means we have not decided to liquidate our company. Company is going concern. Okay. Understood? We have decided. Yeah. And let's say actual sale or the actual close down, you can say. Actual sale will happen at this point of time. This is what? Y1. This is Y2 is our reporting date. Y3, Y4, Y5. Means from reporting date, after 3 years will be actual sale. Quite possible. Now, whenever there is an actual sale, yeah, actual close down of the business, there will be some restructuring cost. Restructuring cost. Example can be, there can be some legal expenses, or there can be some termination compensation payment to employee, because many employees will be terminated, we need to pay some compensation to employee. So there may be some termination compensation to employee. Means when I am saying restructuring cost, we are only discussing about that restructuring cost which resulted due to restructuring. Means it does not include any ongoing expenditure. When I am saying ongoing expenditure, that expenditure which will be incurred even though restructuring has not happened, that is not included. So excluding ongoing expenses. Ongoing expenses means suppose there was some premises which we have taken on rent and we are paying rent for that. So rent is a part of ongoing expenditure now. So that is not a part of restructuring cost. That is not a part of restructuring cost. Means simple word we can say incremental cost only, which happened because of restructuring, which is only because of what? Restructuring. Understood? Now the question is that because already we have decided, so should we create a provision for this restructuring cost? This is the point of discussion. Understood? So what our India 37 decided does not mean you are committed. You have decided does not mean actually you will do it. Right now we don't know. This too I am saying actual position after 5 years, but at year end 1, at year end 2, we don't know whether it will be actually sold or not. You have decided to sell it, but actually you will sell it or not, that we don't know. Understood now? So what India 37 says that you need to just find out, is there any constructive obligation? Constructive obligation. Is there any constructive obligation? Understood? Constructive obligation for restructuring. So how can we understand there is a constructive obligation? Means can is a constructive obligation arises due to entity's own action? Means are you able to understand? So you need to just find out whether there is some action which actually commit the entity. Means what they want to say is you need to find out whether entity is committed to such restructuring. If the entity is committed, then okay. If you are committed, then okay. Just try to understand. I will just give you one simple example. Correct? Now, one simple example. Are you able to understand? I decided to marry a girl. So whether it means I am committed? No, I am not committed. Are you able to understand? So I decided to marry a girl. It does not mean I am committed. So right now I will not think about my marriage expenditure. Are you getting what I am saying? But once I am committed means what? How you will understand you, sir? You are committed. So when I make a formal announcement of that, once I announce to the public that from single I become mingle, it means what? I am committed. There is some indication with a formal announcement that yes, now I am committed. Now I will think about my marriage expenditure. I am just giving one example. Don't take it another way. Understood? So it means what India's 37 says that there are two conditions. If both the conditions are satisfied, it means there is a constructive obligation and you can recognize the provision for restructuring cost. But if any one of these conditions, yeah, both the conditions are not satisfied, you can't recognize provision for restructuring cost. Understood? Have you understood this point? Now we can read what is given. It is a program which materially changes the scope of business. Okay. For example, sale of division, termination of division, changes of business location or relocation. Understood? Without affecting going concern assumption. Going concern assumption remain valid. Okay. Then a provision for restructuring cost required when recognition criteria of provision are satisfied, means when the three conditions are satisfied. There must be present obligation arising from past event, outflow is probable and a reliable estimation can be made. A constructive obligation for restructuring arises when entity is committed, when entity is committed. So how can we understand entity is committed? When both the conditions are satisfied. entity has a detailed format plan for restructuring. You only say when we will create a detailed format plan when we are committed. So entity has a detailed format plan for restructuring. Entity has a detailed format plan about restructuring, and entity has started to implement such plan. They have a plan and they started to implement such plan. Suppose they have given one advertisement to the news they have given an advertisement in the newspaper that we required some buyer for our business. It means implemented such plan, started to implemented such plan. Correct. So entity has detailed format plan for restructuring and has started to implement such plan, or have announced the main feature of restructuring, or they have made a announcement for the main features of restructuring plan to the person, to the people who are affected by it. Means they have done the announcement to the members of the company, to the employees of the company, to the creditor of the company that we are going to sell our division. It means they are committed. Otherwise, they will never do the announcement. Yes, sir. So entity has a detailed format plan and started to implement such plan or announce the main features of the plan to the person affected by it. Understood? If both these conditions satisfied, means committed, means there is a constructive obligation, then we can recognize the provision for restructuring cost. Now, what will be the included in the amount of provision? So what they are saying, a restructuring provision should include only the direct expenditure arising from restructuring, which are those that are both necessary, entailed by the restructuring, means which are only because of restructuring, and not associated with the ongoing activities of the entity, and that are not related to the ongoing activities of entity. In simple word, incremental cost means only incremental cost will be included. Understood? Then one clarification has been given that a restructuring provision does not include this following cost, because this actually depend upon the future conduct of business. It will not include retraining or relocating continuing staff, means any relocation expenses, correct, or retraining expenses. Means suppose the employees are given training, or employer relocated from one business to another business. So that expense actually depend upon the future conduct of business, and therefore this will not be considered for restructuring cost for which we are supposed to create provision. Marketing expenses, investment, new system and distribution network, this will not be included in the restructuring provision. Why? Because this expenditure relate to future conduct of business. Whether we'll give training or not depends upon future conduct of business. Whether we'll relocate the staff or not depend upon future conduct of business. Whether we'll do marketing or not, that depends upon future conduct of business. So these are actually dependent on future conduct of entities business. Understood? Future operating loss, can I say future operating loss whether we should create a provision for that? No. So any future operating loss up to the date of restructuring, means just try to understand that we are right now at this point of time. So can I say if you are closing down business, there may be some future operating loss. Future operating loss, because for 3 years will conduct business or not, because actual close down will happen after 3 years. So whether we should recognize a provision for this? No, we should not recognize a provision for this. Simple. Yes, sir. Understood. So any future operating loss up to the date of restructuring are not included in the amount of provision unless they relate to an onerous contract. Yes, if the contract become onerous, then we should recognize a provision for that. Unless they relate to an onerous contract. Super important or not? Very, very important. Very, very important. I'll take one question of this. I mean, there are many questions, you can do it by your own, but one question, very, very important question I will take, but after the end of the chapter. Means more or less the chapter is over. Let us do the scope and the disclosure part. The chapter will be over. I said now the India start with the scope. Scope means what is covered, what is not covered in this chapter. Correct. So Ind AS 37 is not applicable to following. Ind AS 37 not applicable to executive contract unless onerous. Now you understood. It is applicable only to the contract which become onerous. So if there is an executive contract which is not onerous, Ind AS 37 is not applicable. It is not applicable to financial instrument. Financial instrument right now we don't know, but you can say receivable, any debtor, any investment. I said now provision for doubtful debt. I have not said about provision for doubtful debt. Now I think I forgot to inform you that. My one question to you all, whether provision for doubtful debt is a liability. Whether provision for doubtful debt is a liability. There is no obligation to pay. In this case, so we are not able to recover some amount. So actually it is not a liability. It is not a liability. Can you say if it is not a liability, it is not a provision? Because provisions are liability. Are you getting what I am saying? Now, of course, one doubt will come. So why it is given a name provision? I will say this is not a correct terminology. This is actually a traditional terminology which we are using from our traditional days, but provision for doubtful debt is not a correct term. The correct term is allowance for bad and doubtful debt. So from now you will never say provision for doubtful debt, you will say allowance for bad and doubtful debt. And this is covered under Ind AS 109, coming soon in your life. Coming soon in your life. The provision on doubtful debt means any financial asset coming soon in your life is not covered in this chapter. Chalega. Financial instrument coming soon in your life is outside the scope of this chapter. Income tax. So any income tax we have a specific Ind AS 12, therefore outside the scope of this chapter. Employee benefit, because we have a specific Ind AS 19 outside the scope of this chapter. Yes, we can create provision for gratuity, etc. That is a provision, but outside the scope of this chapter because we have a specific Ind AS 19. Insurance contract. To insurance contract, any provision recognized as per the requirement of Ind AS 117, which is not in our syllabus. So Ind AS 117 is not in our syllabus. Thank you very much, sir. But outside the scope of this chapter because that is covered under Ind AS 117. Then any contingent consideration arising in case of business combination outside the scope of this chapter because it is covered under Ind AS 103. So this is not covered in this chapter. These are not applicable in under Ind AS 37. Chalega. Coming to disclosure requirement. For each class of provision, what are the disclosure requirement? A brief description of the nature of obligation. We should just mention what is the nature of obligation. An indication that uncertainties about the amount of timing of those outflow. So an indication about uncertainties. The amount of any expected reimbursement, if there is any amount of any expected reimbursement, stating the amount of any asset that has been recognized for the expected reimbursement. Means we should state the amount of any asset that has been already recognized as a reimbursement asset. The amount of any expected reimbursement should be disclosed. Simple. For each class of contingent liability, a brief description of the nature of contingent liability. Where practicable, means if you can estimate the amount of contingent liability, where practicable, an estimate of its financial effect, an indication of uncertainties relating to the amount or timing of any outflow, and the possibility of any reimbursement. If there is any possibility of reimbursement, we should also inform, means disclose that particular amount. For each class of contingent asset, a brief description of the nature of contingent asset. An estimate of their financial effect where practicable. Thus, how to estimate this? Ind AS 37 is silent about estimation of contingent asset. Means what amount? But can I say same measurement principle will be used, whatever we have used for what? Provision. But Ind AS 37 is silent about this. Means we can estimate as per whatever we have discussed about what provision. Then when when any of the above information is not disclosed because it is not practicable to do so. Means suppose we are not able to estimate the amount of contingent liability, we should disclose the fact. Then facts shall be stated. Facts shall be stated. Understood. Disclosure requirement are not so much important. Whenever disclosure requirement are important, I will just write down this para is important from examination point of view. So whenever I am not writing, very rare this type of question will be asked. So whenever important, I will write down yes, this para is important. Then you need to retain that particular para from examination point of view. But this is not so much important. Then difference between Ind AS 37 and AS 29. This is not in our syllabus. This is only for general knowledge. That are not in syllabus. So don't try to memorize this. Not in syllabus. Only for your understanding. Already I have discussed. Constructive obligation Ind AS 37 deal. But AS 29 is silent. Discount Ind AS 37 allowed if the time value of money is material. But AS 29 does not allow what? Discounting. Understood. Contingent asset required disclosure in financial statement, but I said that AS 29 used to disclose contingent asset in the report of approving authority, means director's report. Onerous contract AS 29 is totally silent, but in AS 37 says no. AS 29 is silent about this particular point. It requires recognition of impairment loss on the asset dedicated to such contract before any provisions created as per Ind AS 37. For this point, AS 29 is totally silent. Already we discussed this point under Ind AS 37. Chapter is over. Correct. Now let us come to one question. Very, very important question. Till now that question has not been asked in exam. So can be asked in exam. This question. Come to 32. Write down MRQ. Expected also. What is given? On 1st Jan 2002, the directors of JSL Limited decided to terminate production at one of the company's division. Okay, sir. Means can I say decided? Means it is a case of restructuring, but right now only decided. The decision was publicly announced on 31st Jan 2002. So publicly announced, can I say announcement will be done only after detailed farmer plan. Means can I say both the condition is satisfied and it gives an indication yes there is a constructive obligation for restructuring. So even the announcement is done on this date, but restructuring provision will be on 31st March. Provision is recognized always on 31st March. Means estimation will do on this date. That is understood point. The activities of division were gradually reduced from 1st April 2002 and the closure is expected to be completed by 30th September 2002. So they are expecting that closure will be on 30th September. At 31st Jan 2002, the directors prepare the following estimate of the financial implication of the closure. Even though they have written 31st Jan, but estimation will be done on 31st March. Means we recognize provision on 31st March. Be careful. Redundancy cost were initially estimated 2 million. Redundancy cost. Further expenditure of rupees 8 lakh will be necessary to retrain employee who will be affected by the closure but remain with JSL Limited in different division. Can I say it is retraining expenses? It depends upon future conduct of business. We should not create a provision for retraining expenses. So can I say for 8 lakh no provision? The retraining will begin in early July 2002. Latest estimate means can I say on 31st Jan 2002, what was our estimation 2 million? Latest estimate means on 31st March. Understood the emotions of the question. So latest estimate means on 31st March. That redundancy cost is 1.9 million with retraining cost of 8,50,000. Can I say we should create only redundancy cost means what? Termination expenses. Redundancy means reduction in number of employees. So we call it redundancy cost. Correct? So this is due to means you can say redundancy cost means termination expenses. So for this is directly entailed to the restructuring because of restructuring, we need to terminate the employee and we need to pay some compensation to the employee. So this is nothing but termination cost. So for this we'll create a provision. It means we should create a provision for 1.9 million. First para you understood. Second para. Plant and equipment having an expected carrying value of 31st March 2002 of rupees 8 million, means this become carrying amount. We'll have a recoverable amount of 1.5 million. Now this is actually a case of Ind AS 36. Till now we have not done Ind AS 36. Now what Ind AS 36? Impairment loss means impairment loss is for Ind AS 36. I mean impairment loss is as per Ind AS 36. Whenever recoverable amount of the asset is less than carrying amount, the difference will be impairment loss will be charged to profit and loss account. But this is as per Ind AS 36, not as per Ind AS 37. Coming soon in your life. Means in this case we'll recognize an impairment loss 1.5 minus 8. 8 minus 1.5 is equal to 6.5. So this will be charged to profit and loss account. Yes, sir. Then point number 3. The division is under a contract to supply goods to a customer for next 3 years at a predetermined price. Means they have done or they have entered into contract, correct, executive contract to supply goods for the next 3 years. It will be necessary to pay compensation of rupees 6 lakh to this customer. Now for cancellation they need to pay a compensation of 6 lakh. The compensation actually paid on 31st May 2002 was rupees 5,50,000. Now, if this is the amount of compensation which is paid before approval of financial statement, means can I say we should create a provision of 5,50,000? Means right now we need to wait. We need to understand whether this settlement is done before approval of financial statement, yeah, after approval of financial statement. But I know because this is before approval of financial statement, can I say we should create a provision of 5.5? Even though they are saying estimated amount of compensation was 6 lakh, but actual payment whatever has been done before approval of financial statement will give an indication, means evidence about the amount of estimation. Correct? This is as per AS4 Ind AS 10 coming soon in your life. Okay, sir. 5,50,000. Point number 4. The division will make an operating loss of rupees 3 lakh per month in the first 3 months of 2002-2003. Can I say first 3 months of 2002-2003 means, can I say this is after 31st March 2002, and 2 lakh per month in the next 3 months of 2000-2003. This estimate proved accurate for April and May. Can I say this become future operating loss? For future operating loss, no provision is required. Understood? Yes, sir. Point number 4. The division operate under leasehold premises. Leasehold premises. The lease is a non-cancellable operating lease with an unexpired term of 5 years from 31st March 2002. The annual lease rental payable on 31st March in arrear are 1.5 million. The landlord is not prepared to discuss any early termination payment. Now, lease. Can I say lease? You have done AS 19 thoda. AS 19. So I will discuss this point with reference to AS 19 and now it is covered under Ind AS 116. From my point of view, there is one mistake in the question. But to explain the mistake in the question, I need to explain thoda sa Ind AS 116. Can I conclude that 1, 2, 3, 4 you have understood? Let me read the answer of 1, 2, 3, 4. First, let us close 1, 2, 3, 4. 1, you can see estimate of redundancy cost of 1.9 million is the best estimate of expenditure at the date of financial statement are authorized for the issue. Correct? Okay. So this much is required for provision. No charge is necessary for retraining cost. Impairment of plant and equipment is 6.5 million is although not strictly the part of restructuring provision. The decision to restructure before the year end means the related asset need a review for impairment. Therefore, as per Ind AS 36, we recognize an impairment loss of 6.5 million. For compensation for breach of contract of 0.55 millions means 5,50,000. Same principle applies here as applied to the redundancy cost. Correct. So in this case, we need to apply what? We need to recognize this compensation for the breach of contract because they will cancel the contract. Understood? So we should require a provision for this. Why 5,50,000? Because just try to understand, even though in this question they have not given date of approval. They have not given date of approval. But if suppose they have given that actual payment has been done on 31st May, so we need to assume that this is before approval of financial statement. So in this case, actually assumption has been taken. Assume 5,50,000 is paid before approval of financial statement. This one assumption has been taken. However, you can assume that this is after approval of financial statement, then we should create a provision of what? Then our estimated amount was how much? 6 lakh. But in the solution, I think without mentioning this point, they have actually taken a assumption. So we'll go as per ICS solution. Means they have applied what? Common sense. Because if they have given on 31st May, the actual amount is paid. Of course, we should take assumption that this is before approval of financial statement. Okay, sir? Yes, sir. Understood. Then for operating loss, future operating loss, no charge is recognized in 2001, 2002 with respect to future operating loss. This also you have understood. Only I need to explain what? Point number 5. Correct? Listen carefully. We are doing question number 32. Question number 32. Are you all ready to understand this particular point? Bolo. Yes, sir. Now, first let me explain you what actually you have done in AS 19. AS 19 mein what you have done? For lease, there are two parties. Lessee and lessor. And for accounting treatment, lease can be of two classification, operating lease or finance lease. Here also it can be operating lease or finance lease. Understood? Chalega? Are you able to understand? Are you able to understand? Chalega. This was AS 19. But what in AS 116 says कि lessee once again, lease once again, there are two parties, lessee and lessor. And for accounting purpose in the books of lessor, lease can be operating lease or finance lease. Correct? Means AS 19 and Ind AS 116 is same from the point of lessor. But coming to lessee, what Ind AS 116 says, just try to understand. Try to understand. Suppose I have a calculator and the economic life of this asset is 5 years, let's say. And I have given this asset for 2 years to you. So you become lessee. Can you say for 2 years you can use this calculator, and can you say you can use this calculator as per the terms and conditions, and you can derive entire benefit of this asset for 2 years. Are you getting? And can I say I cannot actually stop you to use this calculator for 2 years. Means who is deriving the entire benefit of this calculator for 2 years? You. Yes or no? And can I say you have right to control this asset for 2 years? So what Ind AS 116 says that in the books of lessee, it will be always recognized as an asset and there is no need to classify lease as operating lease or finance lease. Means now as by Ind AS 116, there is no need to classify as operating lease or finance lease. there is no operating lease or no finance lease in case of in the books of lessee, and we recognize an asset and which is known as ROU asset. ROU asset, right of use asset, a new term in your life. In the books of what? Lessee, with a corresponding lease liability. With a corresponding lease liability. Now, how to measure this we'll discuss under Ind AS 116. Right now we are not discussing. I just want to inform you that in the books of lessee now there is no concept of operating and finance lease. Now there is no concept of operating and finance lease. This much you understood, and that is correct also. If I have given some asset to you to be used for 2 years, so for 2 years you can use the asset, you can derive entire economic benefit, and you can control the asset for 2 years. What is the meaning of asset? Asset means any resource which is under the control entity and from which we can derive future economic benefit. So can you say for this asset, whatever has been given for 2 years, you can derive the entire benefit, and can I say you can control that asset for 2 years, and therefore that become your asset. That become your asset, and therefore Ind AS 116 says there is no need to classify the lease as operating lease or finance lease in case of lessee, and we recognize an ROU asset with the corresponding liability. Understood this point? If you have understood this much, now I can proceed. Have you understood this much? Then only I can proceed. Only this much. Ki as per AS 19, what you have done in C enter? Now, as per Ind AS 116, what I will do? What is the accounting treatment? How to measure ROU asset? How to measure lease liability? That is a point of discussion that we'll discuss under Ind AS 116. But have you understood this part? Only this much. Yes, sir. Okay. Now, let us read the question again. Now, you will be able to identify the mistake. The division operate from a leasehold premises, means in this case just try to understand the Joyson Limited is a lessee. Correct? The lease is a non-cancellable operating lease. Oh my God. Can you say? Question mark. How it can be an operating lease in the books of lessee? Yeah, there is some mistake. Chalega, there is some mistake. Because in the books of lessee now there is no concept of operating and finance lease. With an unexpired term of 5 years from 31st March 2002. The annual renter payable on 31st March in area means at the end of each year, are 1.5 million. The landlord is not prepared to discuss any early termination payment. Means there is no early termination payment. Means this cannot be terminated on early basis. Following the closure of division, it is estimated that Johnson Limited would be able to sublet the property from 1st October 2002. Johnson Limited could expect to receive a rental of 3 lakh for a 6-month period from 1st October 2002 to 31st March 2003, and then annual rental of 5 lakh for each period ending 31st March 2004 to 31st March 2007. All rentals were received in arrear. Any discounting calculations should be performed using a discount rate of 5% per annum. You are given the following data for discounting at 5% per annum. They have given discounting factor that we can use. Now try to understand. We are discussing the point number 5. Right now, try to understand. Right now we are standing at which point of time? Means 31st March 2002. We are standing at 31st March 2002. And the remaining lease term is how many year? You can see they have given what is the remaining lease term? Okay, unexpired term of 5 year. So unexpired term of 5 year चलेगा. Means can I say 1, 2, 3, 4, 5. So this become Y1, Y2, Y3, Y4, Y5 if you want to write down. 31st March 2003, 4, 5, 6, 7. And what is the lease payment which is payable at the end of each year? So that is 1.5 million. So it is 1.5 million, 1.5 million, 1.5 million, 1.5 million, 1.5 million. And what is the sub lease receivable? Means sublet, it can be sublet, it is given. So if it is sublet, some amount is recovered. So I am writing lease receivable. Receivable for sublet. So it was sublet at this point of time. So for first year, how much amount is recovered for the 6 month? It is given how much? For the 6 month it was 3 lakh and for the next year it was 5 lakh. So it is 3 lakh means 0.3, this 0.5, 0.5, 0.5, 0.5. Understood? Have you understood? Correct. Now just try to understand when it was AS19 okay. Can you say right now it is an executory contract? And now it become onerous. Now it become onerous. Onerous means what? Because the expected benefit is less than the expected cost of meeting the obligation. Because you can see sublet, they are able to recover only what? This amount which is more than the lease payment for the principal lease, and therefore it is an onerous contract. Correct now? And if it is an onerous contract, we should recognize provision for onerous contract. Okay. When it was AS19, okay. But try to understand when we come to Ind AS 116, already we have recognized the lease liability for this particular lease payment. So already we have lease liability in our books of account. From my point of view, now this particular para is not actually considered for restructuring cost, because already we have recognized restructuring, already we have recognized the lease liability for lease in the books of lessee. Why? Because our journal entries ROE asset account to lease liability, and as per Ind AS 116, lease liability is the present value of all lease payment. Means can I say from the point of view Ind AS 116, already lease liability has been accounted in the books of account of lessee. So why to create another liability? We are not supposed to create other liability now. Are you able to understand? From my point of this para is not correct. This should not be considered in this particular question, but they are asking this particular point. If they ask in exam, you should go as per ICAI solution. So as per ICAI solution, what they have done? As per ICAI solution, what is the net amount? Net amount is what? This become 1.20, 1.0, 1.0, 1.0, and 1.0. Now we should calculate a present value of this. So of course you can create a present value for this. Already a discounting factor has been given. Come to the discounting factor. Present value of rupee 1 received at the end of year 1 is 0.95. Correct. And present value of rupees 1 received at the end of year 1 to 2 inclusive. Means can is 1.86 is inclusive of 0.95. Similarly 2.7472 is inclusive of this. 3.54 is inclusive of this. 4.32 is inclusive of this. So can we do in this way? 0.95 we can use for this 1.2 into 0.92 now. 0.95. How much it is coming? That is 1.14. And for 1 we can use annuity factor, and the annuity factor will be 4.32 minus 0.95, because 0.95 is included in that. So we can do 4.32 minus 0.95, that is 3.37. So what is the answer? That is 4.51. Let's see what is the answer they have given. You can see they have also recognized 4.51. The net cost of fulfilling the contract is 4.51. But totally bakwas. From my point of view, this answer is not correct. I will say this should not be the part of the question only. Because now it is covered under Ind AS 116. It will not be covered under what? Ind AS 37. Understood? One comment I have given. Whenever there is some doubt, conceptually, I have given one comment. What comment I have given? The suggested answer follow pre-Ind AS 116, means before Ind AS 116 there was Ind AS 17, which was actually similar to AS 19. Approach of recognizing an onerous lease provision under Ind AS 37. However, under Ind AS 116, the lessee already recognized a lease liability for unavoidable lease payment and a corresponding right of use asset. Therefore, separate provision for onerous lease obligation generally not recognized even if the expected sublease income is lower than the lease renter payable. Instead, expected sublease renter are considered while assessing the impairment of ROU asset under Ind AS 36. Hence, the treatment adopted in suggested answer appears to reflect legacy. Legacy means old Ind AS 17 accounting principle and is conceptually debatable in current Ind AS 116 framework. Means I'm not saying don't follow this because ICA has not changed the solution. Will follow from examination point of view. Follow this only until there is some changes in the solution. So whenever there is changes in solution, I will inform you. Nothing to worry about that. But till then, you need to use this. Solution, so you have understood. Solution you have understood. Okay, sir. Got this point. With this, we completed Ind AS 37. Means most of the question where doubt will come, I have done. Okay. The chapter is completed. Chapter is over. Balance all questions. I think you can do it by your own. Okay. Come to question 22 once. What is given? An engineering goods company provide after sales warranty for 2 years to its customer. This question I have taken from CA Inter. I like this question personally. Therefore, I have taken. Based on past experience, the company has been following policy for making provision for warranty on the invoice amount on the remaining balance warranty period. Means what was the actual warranty period? 2 years. But they create provision based on the remaining balance warranty period. Less than 1 year, if the warranty period is less than 1 year, then we create a provision of 2% on the invoice amount. More than 1 year, then we create a provision of 3% on invoice amount. The company has raised invoice as under invoice date 19 Jan, 29 Jan, 15 October. This is the invoice amount. Calculate a provision to be made for warranty according to AS 29, but now it will be in AS 37. I said now I have taken this question from CA Inter. Correct. As on 31st March 2012 and 31st March 2013. Also compute the amount debited to PL account for the year ended 31st March 2013. Means we are doing question number 22. Question number 22. So this is 31st March 2003, 31st March 2002, and this is 31st March 2001. Let's see. Oh, sorry. It is 11, 12, 13. Better write on 11, 12, 13. 11, 12, 13. Now the invoice amount is given what? First is 19 Jan 2011. So 19 Jan will be somewhere here. Second date is what? It is 29 Jan 2012, somewhere यहाँ पर. And third date is what? It is 15th October 2012. 15th October will be somewhere यहाँ पर 2012. What is the invoice amount? 40, 25, 90. 40,000, 25,000 and 90,000. They have asked you to require provision as on this date and as on this date. They have not asked as on this date, will not calculate here. Whatever they have asked, will do that only. Chalega. You can see they have asked as on 31st March 2012 and 31st March 2013. So can I say as on this date, they were two amount. And for this amount, can I say warranty period of more than 1 year has been expired? Means unexpired is less than 1 year. Means for 40,000, will create a provision based on 2%. Why? Because the unexpired warranty period is less than 1 year. But you can see for these, only this much month has been expired. Means the balance unexpired warranty period is more than 1 year. More than 1 year, and therefore for 25,000 will create a provision based on 3%. Now, so why 2%? Why 3%? This is the best estimate given by the management. We are not here to question that. So what is the answer for this? You can see 40,000 into 2%, it is 800, and 25,000 into 3%, it is 750, and therefore will create a provision of what amount? 1550. Understood? Correct. Now coming to the next year. Here, so you can see for the first invoice, 2 year is already expired. Means for 40,000 will now not create any provision. Now for 25,000, you can see this much year has been expired. More than 1 year has been expired. Means less than 1 year is now left to year. Now for 25,000, will create a provision of 2%. And for 90,000 understood, will create a provision of 3%. So how much it is coming? 25,000 into 2%, that is 500. And 90,000 into 3%, that is 2,700. It become how much? 3,200. This is the provision required at the end of means 31st March 2013. Means how much will be debited to the profit and loss account of the last year? That is 3,200 was required. How much already created? 1550. So how much required? So 1650 will be charged to profit and loss account, because there is an increase in the amount of provision. So that increase in the amount of provision will be transferred to profit and loss account. Understood? Good question. Therefore, I have taken. Understood? You can see 1650 has been explained in this way. Can be asked in CA final exam also. Okay, sometimes they take question from CA inter and ask in CA final. This question you do by around 21. My help is not required. 18 also you try. This question is similar to question number 32. Already I have done. This question 15 also you do. If any doubt, we'll discuss. 12 also you do. Doubt will discuss. I think doubt will not come. Balance all question you also do. Means I just identify some of the question. If suppose you have some restricted time, do whatever I am just asking you to do. That much do you do. Understood? Yes, sir. So today I will not start any other Indias. This much only. I was slow for first 2 initial days. Why I was slow? Because sometimes what happens, if you are not habituated of my way of teaching, you should become first habituated. Then only you can understand whatever I am saying. So today this much only. I hope you have understood India's 37. I have taken much time. Tomorrow we will start India's 10. Done? Okay, sir. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Bye bye.